So what's normal economic growth in China? Well, everyone's used to the idea that it's normally 10% or something. The 20-year average GDP growth rate is a bit above 9%. But looking at this graph, 7.5 looks more normal, and I'd say there's very little chance of it ever getting back into double figures or even back to 9%. And that's mainly because the Chinese economy is so big now. The addition to gross domestic product each year is now more than the entire GDP was 20 years ago. Growth will probably fall below 7% this year, but that's still a lot of stuff. Today's figure of 7.3% growth for the December quarter was a touch ahead of expectations, so the Shanghai stock market had a bounce from yesterday's big drop that followed the government's crackdown on margin lending to finance speculation. The Swiss market also finally attracted some buying, having dropped 15% since last Thursday's decision by the Swiss National Bank to cancel the currency peg. Commodities probably fell because of the IMF's downgrade of global economic growth, although that was hardly a surprise, coming a few days after the World Bank did the same thing. But oil went into reverse, as did base metals and gold. And speaking of oil, there's a lot of commentary that the price has collapsed because supply exceeds demand, because of weak economic growth and lots of production by OPEC and the US shale producers. Well, actually, that's not right. Demand and supply are still basically in line. The price has collapsed because speculators on the futures market expect supply to exceed demand, but it hasn't happened yet. And on the local share market, energy stocks fell, while banks and Telstra, the dividend stocks in other words, all went up. So the All Ordinaries was flat. And the Australian dollar is a little bit lower, but not much. And that's finance.